Hey, everybody, welcome back. And it's been an interesting week. We were out at the Northwest Credit Union Collectors Association, and what a great bunch of people. And I'll tell you, if you are not working with a credit union, you absolutely should, because I'll tell you, man, everybody there is working in the best interest of their members. And, that's one of the reasons we really enjoy working with them. So I'm doing a shout out to all of those credit unions out there in Washington, Oregon, California, Idaho. Great job, you guys. And, I just love the fact that you guys actually care, which is awesome, versus the big box banks, which, well, they don't really care. You're just a number. But anyway, moving on. So the question is, hey, we got some numbers in on CPI. The feds, though, don't look like they're going to lower any rates, which I think is a good thing. Let's find out why. Okay, so when we take a look at what's going on in the market, and we know that the interest rates right now are kind of the magic pill that's going to, bring the buyers off of what I would call kind of the sidelines. Why? Here's the thing. The interest rates, are bobbling around 6.87, 6.87. And the reason is some of the dynamics, but understand, that is also situation normal. That's our normal rate for us. That's a healthy, balanced rate for a lot of things. Yes, of course, we always want rates to be lower. Yes, I know inflation, which has been simmering down, and that's one of the reasons that rates came back down, unlike last week where we had excellent job reports, and rates actually bought back up again because of people moving in and out of bonds. Now, as we take a look at that, and you might say, okay, George, what the heck are you talking about? Why would it be so beneficial for the feds not to change rate right now? And here's the why. Every time this year, and including as far back as September of last year, every time the feds cut the rate, as you see the steps, you can see that the mortgage rates went up, and then they would start to correct. Feds would drop, then rates would go up again. And that is situation normal, because again, the two have nothing to do with each other. However, here's the thing. So in July, they're going to be meeting again. Actually, they're going to be meeting next week. And so we're expecting situation normal. I don't expect the feds to do any form of adjustment. 6 weeks later, they're going to take a look at it again, because they only meet once every 6 weeks. And I think, again, it's going to be flat. September, maybe they will do an adjustment. But based on the metrics, based on where we are going in the market as far as keeping CPI, right? It's been going down lower and lower, and jobs have been, staying at least a little bit better. We're going to see that situation normal, and the hope is that we're going to drop those rates down into the 6.75, 6.5 as we head into closer to our summer market. Now, after July 4th, for all of those sellers out there that are going, hey, man, where'd all the buyers go? Which is situation normal, because it's still part of the vacation trifecta. And it's interesting because after July 4th, you're going to see a surge of buyers. You can see a surge of activity until about the middle of August. Why? Well, people want to secure their home. They've been acclimated. They've gone through most of the vacations. You only have, Labor Day, Memorial Day. Labor Day that's coming up in the end of August, September. They want to get situated for schools, things like that. And that's why we see that bump. Now, towards middle half of the latter half of the middle of August, we start slowing back down again. Okay. Last minute vacations. We've got kids getting back in school. We have a few things transitioning, and they want to basically their mindset is not on purchasing a home. And we will actually start picking up at the end of September, first part of October. We'll pick up until mid-December. Now, with that in mind, let's continue our little show here. Let's talk a little bit about what's going on. So purchase demand near 2-year highs. As refis start to bounce back, because we saw some better rates, even though on the upper right-hand side, you can see we went up by 2 basis points. Not a huge amount, but again, based on the fact that even we had some really good reporting, we did not bounce up over 7%. which again, the one just below that, good news on inflation, but don't expect a rate cut. And that is 100% normal because the Feds, they're looking at what's going to happen with tariffs. How's that going to affect employment? What is that going to do for everybody that is out there on the bigger scale? So they're going to hold off. I don't expect anything next week at all, nor the following time that they get together, but we'll see. All right. So if we then move on and we take a look at what's Fannie's running average here, well, look at that. We're actually down year over year, and we're down from the prior week. Super awesome. Why? Well, simple enough. With rates coming down, and that's why we're seeing kind of a new resurgence of buyers and refis, because they're getting the gist. Oh, you know what? Yeah, I think we're gonna be in this ballpark for a while, and that is, I think, very much true. We might hit down to the 6.5s as we get later on in the year, but not anytime soon. But right now, let's talk a little bit about inventory, because there's a lot of noise out there about inventory. And again, let's talk about ours first. Here we go. We had the running day, 7-day average here. We had 1,471 homes come on market. Yet we had 1,300 homes going off as far as pended. Now, yes, we saw a massive number of price reductions, which is situation normal. Had a couple of sale fails. That's our back on market. Absolutely 100% situation normal. Okay. And you might be saying, George, I don't know. People are saying, inventory's gone crazy high and prices are being slashed and everything else. And I'm like, time out. We're just finding sellers are not being able to be as aggressive with pricing with more inventory. That doesn't mean that home values are necessarily falling. I'm going to show you there in a quick minute what I mean. But let's take a look at things on a national level. When we look at this on a national level, you can see the highlighted yellow. That's us, right? And yes, we are higher than, go figure, 2020, 2021, and 2022. Why? Super simple. Those are our one-off years, kind of like 2008, 9, and 10. We got to take 2008, 9, and 10, throw those out, because those were exceptionally high inventory levels. Just like 20, 21, and 22, we got to throw those out, because again, those are exceptionally low. Very, very unique situations. And of course, with many statistics, right? You take out the high, you take out the low, and what do you have left? Okay. And that's where we're at today. We are very much rolling down I would say, the flatter side of things. So when we hop over and we take a look at what's going on, look at that. So if we look at the right-hand side, actually, let me blow this up for you guys. There we go. Look at this. So we are pretty much flat. Yeah, sure. We're up about 2% as far as year over year for sales. That's the upper chart. And then we're up about 2.5% when we talk about the, more pended homes than we had last year. Okay, so that's positive, but that's pretty flat, because as you can see from the numbers there, 25,626, 25,150. You're only talking what, 400 and some odd, 500 homes, 475 home difference. Pretty small potatoes. Even when we take a look down below, look, we had 426 homes come on market over what we had last year. Funny enough, we had 438 homes that went pended. And as you can see from this chart, we're actually, every home that we add, we're taking one off. Okay. Well, I call that more a balanced market. It's not leaning more towards the sellers, more towards the buyers. We are smack dab in the middle. We still see multiple offers on well-priced homes. Sometimes a market will have greater or lesser demand, especially if we have new construction in the area, because they're able to offer more incentives as buyers hit the sidelines and continue waiting because they're afraid of rate or maybe just qualification. Whereas builder incentives, they're able to get a 2-1 buy down and typically a better long-term rate in the end with new construction. But there's the trade-offs. You end up spending more. You don't get maybe as a good of an area as that you want. So there's those trade-offs that people are looking for. And in fact, new construction actually did much better as we take a look at, in fact, let me just pull those guys up here. Actually, before we do that, let's talk about price. Remember I said, hey, price is actually, heading in an upward trend. Center chart year over year, we're up $4,000 from where we were at last week as far as the average sold price. Year to date, we're up $2,000. You know what that means? It's flat. Very flat. But we're not going down. We're just kind of riding the wave, just staying the course. Nothing super exciting either way, which some people might say, well, George, if you're not going up, you're going backwards. Sometimes, but on this scale, all things considered, we're doing better in some of the other areas. In fact, our foreclosure rates, we are third or fourth from the bottom, which is excellent because you want to be the bottom. And we're only separated by 0.02% as far as being the bottom. So our foreclosure rate, our default rates are super low. We'll get into that a little bit more. So as we head over into new construction here, and we take a look at what is going on, hey, listen, they've actually been doing a pretty good job, all things considered. So when we look at this year to date, the upper chart, look, we're 511 more homes on market than what we were at last year at this time. Okay, a little bit there's fewer newer homes on market, only by a few 100,000, but our solds are off about 441 homes year to date. That's about 74 homes per month. Now, when we look at it that way, it doesn't seem like that's any crazy number. The thing of it is, they are offering a few more incentives, which really at the end of the day, the new construction, even though they're getting their sales numbers up, what they need to, they're still kind of lagging behind. Now, granted, this is 3/4 of Washington State, and new construction has been lagging quite a bit. And a lot of that, price. Price has a huge factor on this one. And that's something to keep in mind because they get that 10% premium. Smaller lots, sure, it's new, but people would like to have a little more space. Updated, remodeled homes can be just as inviting, but you don't have to drive as far for a lot of folks that are having to come back to work. All right, so if we pop over and we start taking a look at what is our year-over-year price, what are we looking at there? What are we looking at as far as list price to sales price compared to last year? Are we still seeing an upward trend or are we sinking down? Well, funny enough, here we go. So we're actually up year over year, 14%, at least for the month of June so far, and we're up 2.9% year over year. And so again, they're just edging up ever so little, nothing earth-shattering at all. In fact, it's pretty nominal. We would expect something a little bit better. In fact, last year we had hoped to see about a 4.5% appreciation this year with new construction, and we're just not quite there. We're about half that at around 2%. So again, still very much flat and nothing super exciting at all. Now, when we talk about REOs, here's the funny thing. So as you can see, again, we really don't have much of anything in the REO world. As you can see, there are not very many homes at all. And when we take a look at it, keeping perspective, you can see that we are actually quite low. Even where we were prior to 2007, our numbers are super low. And that is consistent with what we're seeing with all the other metrics. Again, here we are. We're, basically the bottom of the list here, and not the bottom, but we're fourth from the bottom. This is not a complete list. And here's the funny thing, even on a national level, all of our rates are quite low. So when we take a look at what's going on numbers wise, hey, look at this. Even year to date and month over month, our numbers are super, super tiny. Sure, we could say that pendants are up in foreclosures by 75%. That's only 6 homes. Okay, it's like last week when we talked about the government organization that was touting that we had a 54% increase in foreclosures. That's because that number looked better than the actual real number that went up, just like our 6 homes going to 75%. Hint, hint. Anyway, with that, if you guys have any questions, smash that subscribe button, put your information down below as far as asking your question. We respond back. There's no strings attached. There's no marketing. Have an absolutely fabulous weekend. I will see you on the next video. And, well, go on and have some fun. Take care.